Folks, on this channel, we are so lucky to bring experts with a wide range of experience. Our Monday guest, Taylor from Life Goal Investments, was a 10-year veteran of Wall Street. So what I want to do with a Wall Street veteran is talk about a stock market crash. I'm going to ask him to put some numbers on it, and we are going to relive some crashes from the past and talk about what might be an earnings recession, maybe a crash, maybe a correction coming. But Taylor, how you doing, man?
I'm doing great. This is an exciting topic because I think a lot of people are rightfully scared about a potential crash coming in the stock market.
So let's put some numbers on this first. Let's talk about a correction and then a crash so we can at least start that definition. What would you call a correction? And then what would you call a crash in the stock market?
Yep. Technical definition of a correction is a 10% drawdown from the peak. So we've obviously experienced that thus far. The next step is a bear market. A bear market is a 20% drop from that peak. And then a crash, admittedly, a crash really doesn't have a true definition. But if you were to throw me under the bus and say, hey, Taylor, tell us what a crash is. A crash is maybe when the market loses a third of its value from its peak. And I think what realistically, the crash is more of the sentiment than it is anything else. When you a hyper fast drawdown and all conviction in the market is lost seemingly overnight, and this feedback loop of selling begetting more selling drives the market down further, that's what I would call a real systematic crash in the stock market.
If you were going to look at one metric, and I know there are many that would kind of highlight a crash is happening, would that be the VIX? Is that kind of the indicator for stress in the market? It would spike?
Yeah, that's a really good indicator. So generally there's a negative correlation between VIX and the stock market. So the VIX is often known as the fear gauge, right? So as fear goes up, the VIX moves up. And generally what happens when the VIX is moving up is stock market is getting a crash on the other side, is coming down meaningfully. So again, that negative correlation between the two. And then when the VIX starts to depress downwards, that's when you start to get some calms in the market. And generally calms in the market come with a slow drift higher in the stock market. So to your point, historically, when we've gotten really crashed in the market, you've gotten a massive leap up in the VIX very quickly. If you get a 40 or a 50 handle, if you get to a 60 handle on the VIX, that is when you have that hyper tension in the market. Normal, for context, is about 20. And what you'll see is generally a move higher very quickly, and then you'll have it settle in very slowly as things start to get digested and people start to realize maybe we've overcooked this sell-off in the short term.